Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern every Monday morning. Get you ready for the week, stocks to watch, economic news that could guide the market. And every once in a while you research a stock and everything just seems to fall into place. A company is in a growth industry, changing our world. It has a competitive advantage over its peers. Unfortunately, a lot of times the price multiples on these are extremely ridiculous. The rest of the market also sees that upside in the stock, and investors are paying through the nose with share prices of 10 and 20 times or more its current revenue. But every once in a while, the market forgets a stock and gives you a second chance to start buying in at a price just too good to pass up. That's where shares of SoFi Technologies were last December when I started buying. They're now up 75% so far this year, and I'm going to show you why I think they could have another 75% left to go. Stick around after that. We'll do our Monday market update with the stocks to watch and the economic news you need to see. But first, I want to highlight a special offer from one of the platforms I use. I use Webull for its paper portfolio that lets you test out your strategies before investing your own money. You can buy stocks in your paper portfolio, see how they do, and test out your ideas before investing. You can invest in stocks, options, ETFs, and crypto on Webull and pay no commissions for stock trading. The advanced charting tools and level 2 quotes are a must for traders, and you'll earn 5% on your uninvested cash. Webull offers transfer reimbursements up to $100 if you transfer from another investing account. Look for the link in the description below. Sign up and deposit any amount, and you're going to receive up to 12 fractional shares of stock absolutely free, with each share worth up to $3,000. There is a lot to like here besides that 5% return on your cash, the free shares, and the stock simulator, so make sure you check out that link below. Back to our main topic though, because shares of SoFi Technologies, ticker SOFI, are up over 75% this year. I'm up 41% on my position, one of the largest in my portfolio, and a profit of nearly $50,000 over the year. And I think that's just the beginning for this forever stock. Shares of the online banking leader could run another 75% just to my target of $14 a share and become a major bank. I started buying shares in December of 2022 when SoFi was at $4.30 each, down 83% from its 2021 peak above $25 a share. Of course, a lot of investors said I was crazy, the kind of investors other YouTube channels have taught that you only need to look at a stock chart to pick stocks. And the stock chart was not pretty. But I did my research. I saw an online bank, the only growth segment in this industry, with a competitive advantage over its fintech peers. I saw SoFi's online operations gave it a cost advantage over those legacy banks with their expensive branch networks to run. SoFi's banking charter also gave it that funding advantage over other fintechs, over other online banks, allowing it to take in those low-cost deposits and offer complete financial services. This qualitative analysis was then backed up by the numbers, strong growth in the company's user base and revenue. Since then, I've built a position of 21,000 shares at an average cost of $5.74 a share. When the shares jumped to $11.70 this year, I was up over $125,000 profit. Even on that pullback to $8.12 a share, I'm up 41% and almost $50,000 on the stock. But even that is only about halfway to my long-term price target for this stock. To start, SoFi's total assets of $25.5 billion make it about the 83rd largest bank by assets, about the size of United Community Bank in South Carolina or the First Hawaiian Bank. Each of these banks had about 500,000 to 600,000 customer accounts as of the last quarter. By comparison, SoFi booked asset growth of 61% over the last year. The average asset growth for the top 100 banks was just 6.7%, and 34 of those saw their assets decline. SoFi grew its members to 6.2 million in the second quarter, 44% growth over the year, and while member growth is slowing, that's still pretty amazing year-over-year growth. But it's the revenue growth and profitability that's really surprising me. SoFi grew its revenue at a 37% annual pace in the last quarter to $1.8 billion, and profitability on an EBITDA margin improved from 11% last year to 16% this year. That is high double-digit growth at the same time getting more efficient in turning that revenue into earnings. And while other banks were hemorrhaging deposits in the first half of the year, SoFi grew its deposit base by more than $5 billion to $11 billion in the first 6 months. Fitch Ratings reports that deposits at smaller banks fell by $150 billion in the first half of the year, and even the more stable, larger banks saw a $29 billion hit to deposits. Here again, SoFi has the advantage against other fintech startups with its banking license that allows it to take in those low-cost deposits and offer traditional financial products just like a regular bank. You see, most fintech online banks can't do this. They don't have a banking charter, so they have to rely on more expensive equity and debt financing to fund their loan products. Against those more traditional banks, though, SoFi has the advantage of a totally online network, cutting out the operational costs it takes to run that branch network. All this feeds into the consensus outlook that SoFi can grow its revenue to $3.7 billion over the 3 years to 2026 from $2 billion this year. Here we see that in the forecasted revenue, and I actually think it can go even higher than this, up to $3.85 billion in those 3 years. Here in the valuations, we see shares currently trade for a price of about 4 times on a price to sales basis, price to revenue, up from a low of 2.9 times revenue last year, but also well off their heady days of 15 times in 2021. Of course, growth will slow down as the bank adds depositors and size, so that price multiple could come down, but even at a reasonable 3.5 times price to revenue valuation, times the $3.85 billion forecast for 2026 revenue, still gives us a $13.5 billion market cap. If we divide that by the current market cap of $7.7 billion, that gives us 75% higher upside from here and a $14 per share target. Comparing that with analyst estimates, here we see of 15 analysts an average price target of just under $10 a share, but now that is a 1-year target and with an upside of $16 per share. Now this low of $3 a share was just added in August and is clearly an outlier, pulling down that average. So my $14 price target over the next 3 years is a conservative estimate. Investor sentiment could jump when the bank reaches net income profitability next year and drive that price multiple higher. SoFi is also unlocking other revenue streams not yet built into those forecasts, like its investment banking group that recently participated in the underwriting for the Instacart IPO. So that revenue growth could continue to surprise higher as the bank unlocks more traditional banking segments and grows into a powerhouse bank. Here we see the current earnings and sales estimates for the stock. Earnings are out on October 30th, with SoFi expected to report 22% revenue growth to $512 million and an earnings loss to narrow to 7 cents a share. Now, with a growth stock like this, you do always run that risk that one bad quarter is going to shock the market and send the shares plunging. For SoFi investors, it would be an opportunity, and that longer-term outlook is clearly higher. Going to open it up to some of the stocks I'm watching this week. First up, Crown Castle, ticker CCI, reports its earnings on Wednesday with shares down 55% from the December 2021 peak. Now, I highlighted CCI and the other cell tower REITs as some of my favorite forever stocks in a video last week. The drop in shares is entirely an interest rate story, and when those rates start coming down next year, these stocks are going to jump higher. In the meantime, investors are being paid a 6.6% dividend to wait. Netflix, ticker NFLX, is going to be reporting its earnings also on Wednesday, with the market expecting growth of 9% in sales to $8.5 billion and a $3.50 per share earnings. Now, shares are down 27% from the 52-week high set just a few months ago, but analysts expect weak sales growth this year of just 6.5%, then 13% next year. Now, despite that recent near-term weakness, though, this stock is getting to an attractive point. Netflix is the clear winner in the streaming wars, and its exposure to international production is going to help it extend that gap for as long as the Hollywood actors strike continues. At a price multiple of just 4.6 times this year's expected revenue, it's not cheap, but it is no longer expensive either. Next up is Tesla, ticker TSLA, also scheduled to report on Wednesday, with the stock struggling after missing its quarterly production forecasts earlier. Expected earnings for 74 cents a share would be 30% lower than a year ago quarter, and full-year earnings are expected 18% lower to $3.35 per share. Against this, though, sales are expected to continue booming at a 22% annual pace through next year's estimates. The company has the clear advantage in those lower-cost EV production versus the legacy automakers who are going through a lot of union wage problems right now. Shares of Tesla still trade for about 9.3 times revenue. That's down slightly from a year earlier, but still almost double the trough of 5.5 times we saw last year. So long-term growth is intact, but I'd like to see the price come down just a little bit more before buying any more shares. Alaska Air, ticker ALK, is going to be reporting its earnings on Thursday, with the market expecting earnings down 24% from last year, just 1.9% sales growth. Now, the good news here is that this should be the last quarter for the airline before earnings begin rising again, and the stock is actually one of the top 10 highest upside potential among analyst price targets. Analysts have an average target of $62 a share over the next year. That's more than 87% above the current price. Now, while shares may provide a good upside, those price targets may have to come down a little bit on a weaker economy. Delta Airlines did report their earnings last week, and revenue expectations gave an optimistic outlook, but the shares still fell 5% on just slower freight demand. Looking at that bigger picture idea with the sectorspiders.com sector tracker here, great free tool here on the internet. Looking at the last week, 5 days, 9 of the 11 7 stock sectors did close higher last week, though that underperformance by tech stocks really held the broader index back to just that 0.5% gain. Okay, tech stocks are about 20-30% of the larger S&P 500 index, so anywhere tech goes, the index is going to follow. Energy stocks were obviously the standouts with that bump in crude prices, but interest rate sensitive sectors also rebounded, with real estate and utilities within that top 3 of sectors by performance. Now, while I think both of these sectors are very attractive on long-term valuations, interest rates are more likely to go higher than or stay high for at least a few months. That could prolong the pain that we've seen in utilities and real estate stocks, but patient investors are going to be rewarded in these next year. We did see stocks in the consumer discretionary sector take a big hit last week, and it strikes me as possibly a canary in the coal mine scenario. Many companies during the second quarter earnings told of weakening consumers, and all this was before that jump in interest rates and the restart in student loan payments. As we move into third quarter earnings and the outlook for ever important fourth quarters for retailers, we're likely to hear more bad news for the consumer, and that's going to weigh on these stocks, the consumer discretionary stocks, as well as really just the overall economy. Check out that stock simulator on Webull and get up to 12 free stocks when you sign up with the link below. Or click on the video to the right for my forever stocks, the stocks I'm buying for the next 30 years following those mega trends. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.